story that's been on people's lips the last couple of weeks has been this idea that Rachel Reeve wants plan to graduates, or those graduates who have been on this plan to student loan repayment plan, to pay their fair share, which is debatable in and of itself. I mean, if you could just to kind of start off, give me this overview of what the difference is between plan one and plan two, and maybe a bit of the history behind it, because maybe some younger people have only ever been aware of plan two. I think you and I are both aware of what those differences were because we went through the university system when these changes happened. Where is this coming from, and what has led us to this point for this to be a news item this week?
Yeah, so it's I mean, I think it's really interesting that it's become this kind of like big brouhaha in the first instance. It's obviously kind of hit public consciousness in a way that it hasn't in the past. I mean, the government has tweaked the student loan system for years and years and years, like you said, whether we have plan one and plan two, and we're now on plan five or something like that. So the plan two only actually refers to people who took out loans post 2012, and I can't remember what the cutoff is off the top of my head now, but there's only a specific cohort. And the thing is with them is they are all now basically graduates in the jobs market and learning to live with the realities of that jobs market. And I think the post 2012 plan two, that's when the fees really ramped up to $9,000 a year. Like you said, I mean, I had a plan one, my fees were like $3,000 a year or something like that. And look, I'm turning 37 on Sunday. I paid off my loan last year in October, I think, which was a bit of a what's the word, anticlimactic. Although the guy on the phone when I did it was like, congratulations. I was like, oh, okay, thank you. I don't know what to do now. But I got a sizable bit of income back on a monthly basis. 9% of my income was going out, and I felt like getting a substantial pay rise. So that was great. So the problem for the plan two loan people is that because of these kind of the repayment thresholds, the rates of interest that are put on them, which actually go up when you earn more, those rates of interest increase, which is, it works basically in the opposite to how a normal loan works, where you kind of, if you're more credit worthy, you get better rates. This is the opposite of that. And I think it's really just kind of exploded that myth that the student loan system is anyway fair. And I think what's surprising is, like I said, there's a lot of tinkering that's gone on in the past, but it's never created the backlash in this way. And I think there's one really key reason for me anyway, I think that is, and that's because it's a Labour government doing it. I think young people are more inclined to vote for Labour, more inclined to see that Labour is going to represent their interests better. So when the Labour Party comes for the young people, it's, I can't believe you've done this. This is unbelievable. It reminds me a little bit of when we had the Lib Dems way back in 2010, who were promising to, I can't remember what exactly they were promising to, but were they going to abolish the student loans? Yeah. And then they reversed it. And the whole reason why Lib Dems, they always say, when you have coalition governments, it's the junior partner that gets punished for it at the next election. And that's exactly what happened. All the students remembered that broken promise, and they got kicked out of government effectively, but in the 2015 election. And I think there's an element of that here, which is, there's a sense of betrayal, but it's bigger than that. So I wrote about this weekend, and I got into a bit more of a niche topic on it, because I think it's quite well played now that people showing this is what my balance is, I paid X off, but it's now ballooned to Y. And that, I mean, on a personal level, I think that's really fair. And it's obviously it's terrible to have to experience that, to watch your make payments every month and still see that loan balance go up. The thing is, though, it kind of misunderstands what the system really is. So it's you can't even really think of it like a loan, and you should actually just kind of ignore that balance, because it is just a 9% basically effective income tax levy that gets written down. You have to pay it for 30 years, because most people are just not going to pay that off. Now, what I think is really interesting, and we mentioned a little bit there, was youth unemployment is becoming a big problem. Graduate outcomes are becoming a bigger problem. There's a real issue in the labour market, and there's a few different things going on there. You've got the rising minimum wage, which is basically knocking jobs out of the bottom of the ladder, of the career ladder, because it makes it more expensive to hire younger people, basically. That's a big issue. You've also got AI, which is starting to have an impact on certain areas of industries as well. It's a bit more uncertain what's going on there. But now, the reason I'm mentioning this is because this is what I wrote about this week, where actually what happens in the student loan system that is, I think, very under discussed is that there's still a massive taxpayer subsidy that goes into the student loan system. About 30% of student loans that get written in any given year and handed out are immediately written off by the government. So in 2024-25, that was £6 billion of government subsidies of student loans that are written off upfront. So the way they write it off, they look at all of those loans and they decide X number are never going to get paid back because those graduates are never going to earn enough from these student loans they're taking on to pay it all back. It's crazy. Over the whole parliament, the cost is about 34 billion, which is it's a lot of money. And so the point I was getting at with my piece was the problem we have is that these numbers, 5.9 billion in 24-25, 34 over the parliament, it's all predicated on graduate outcomes steadily improving and earnings steadily improving over time. But if we have this one-off issue where graduates are suddenly finding themselves in a worsening labor market through AI, minimum wage, higher regulatory barriers to employment, that kind of stuff, with the new regulations that came through at the end of last year, those assumptions could be too optimistic, and we could find a situation where the taxpayer suddenly realizes they're having to pick up more of the can for the student loan system. And I think that's a ticking time bomb waiting to go off, basically, because once taxpayers realize that they're having to fund more and more and more of it, it's going to become like the arguments over state pension, where everybody's suddenly very upset about the system that doesn't work for anybody. It's crazy.
I think the other issue at play here is we obviously had the Lib Dems going back on a manifesto pledge. I was in a position in, I think it's 2011, so just before they came in, when I was at university, and won tickets for an audience with Nick Clegg. And of course, the question for every student goes is, how can we trust you? You've broken this massive promise that lots of us would have voted for. And for those who don't remember, the 2010 election was a hung parliament. We were coming off the back of a global financial collapse. Everybody was poorer. People lost pensions. People were unemployed. The unemployment rate skyrocketed. I also, think that at the time there was a real call for change. Could Labour have been in power for 13 years? And Gordon Brown did himself no favours on that particular campaign. The thing that Nick Clegg said to that audience of students was, the nation didn't vote me in as Prime Minister and didn't vote for a Lib Dem government. We're a hung parliament and we could not enact everything in the manifesto that we wanted to. What we were able to do, though, is curb the Tories to bring these. We have agreed to bring these rates up, but what we have also agreed to do is put in more stringent and higher levels where students actually have to repay, meaning that fewer students will have to pay overall. Now, this is coming back to the subsidies that are happening. But I think it was 2 years after that, George Osborne sold the student finance debt to, I believe it was Capita, but I could be wrong, but to essentially a private equity firm, which is why we then saw this ballooning of interest rates. And what I wanted to ask you, kind of after your deep dive on this, is if you've got somebody entering, 17, 18 and going, I wanted to go to university, I've got the grades, I don't want to be saddled with this. I'm hearing all these horror stories, and the media is not doing a particularly nice job of saying, there are people out there, and most people will just kind of get on with their lives. There are horror stories out there. I'm sure there are horror stories on Plan One as well. But what would you say to somebody who is at that crossroads in their life where university is a big commitment, not only time commitment and education commitment, a geographic commitment for many people? If they're so worried about the financial commitment to this and what it can mean for them long term, what would you say to that person to either quell their fears or give them maybe a little bit more of a dose of reality than what the media has decided to play out in the last few weeks?
I mean, I find this difficult. I wrestle with this now. I have two young sons. I mean, I've got one who's literally 2 months and a bit old. He's tiny. I've got another who's just over 2 years old. They're still both very small. And this is something that now keeps me up at night, is thinking, what if they one day want to go to university? How am I going to help them do that? Especially if the system as it exists today is it still persists. I mean, there's probably a good I'd say there's probably a good chance that it won't by then. That keeps me up. So I can only imagine what it'd be like now for a 16-year-old who's got all this kind of swimming around, or a 17-year-old who's trying to make these decisions. And I think my kind of really honest opinion here would be, if you want to be a doctor, or you want to do something that's very highly academic, then I think university is still great. And I think you have to exist within that system. And I think if you're aiming for a top university as well, and look, I'm going to be realistic here. If you're aiming for an Oxford or a Cambridge or another kind of top level institution in the UK, then I think it's kind of fine. I think if you're not, and I understand why people go, because they want the kind of lifestyle experience and that sort of thing as well. And it's certainly part of the decision when I made to go to university, but it was an easy decision for me. I would think about, well, is something like an apprenticeship another viable way into a career, as an engineer or in financial services? They are available now. There's lots of stories out there about people joining, all sorts of different industries by doing an apprenticeship. An apprenticeship, you get paid. You're up front. You'll be ahead of your peers in your age group. Now, on that lifestyle point, obviously people want to go and have that experience of meeting new people. And my answer to that would be, is just go take a gap year. Just go do something for a year and just don't do anything. Well, actually, no, that's the best advice somebody ever gave me about my kind of professional career was, you don't have to do anything particularly serious before the age of about 25, maybe 30. It's fine to go and experiment and have fun and do different things, as long as you're not being a complete layabout. It's okay. Life experience is valuable, whether that's traveling or doing whatever. I think there are significant trade-offs now. And I personally, so if it were me deciding now, based on the university I went to, I'd have a very tough time deciding whether I wanted to take on that amount of debt. It's a lot of money. And that being said, and this is something else I thought about for anybody who's already in this position where they're paying off the loans, because there's a lot of discussion about, well, what happens next. My inkling of it is that they are potentially going to start doing some reversals on it, particularly because the politics around it is so bad. The much more kind of left-wing end of things. Even in the US, you see it. They talk about paying off student loans for everybody and that sort of stuff, loan forgiveness. I don't think we'll necessarily get as far as loan forgiveness, but I think, because it would cost an absolute fortune. But I think there will be potentially some changes to the system to even perceptually increase the fairness of it, I think, possibly. But yeah, I don't think there is an easy answer. I think you should think carefully about things like apprenticeships, especially given so many more businesses and different industries now offer them. And look, let's be real about what the future job market looks like. We're talking about a kind of white collar job market collapse and this sort of thing from AI. The people who are going to have value in the future are, and this is like, my wife does the perfect kind of career for this. She's a nurse. She spends time in the community looking after children. That will never be AI'd away kind of thing. You can't, unless they come up with the robots to do that, it's not going to happen. So do something like that. But then this can take us into a whole other route of issues with things like nursing, where to do nursing, these in the past, you used to just go and effectively do like an apprenticeship. You'd go and train up as a nurse. Nursing's a degree now. So I think that there should be a bigger discussion about, why are we making nurses do degrees and making nurses take on all this debt? It doesn't, to me, that doesn't really make sense, especially when we really need lots of nurses. We need to encourage people to be doing jobs like that. They're really important. And it goes to other industries, they're not necessarily student loan dependent, but we need lots of plumbers and we need lots of electricians. We need all these kind of highly valuable skilled trades. And I think there's just not enough focus on doing that. So how does that translate for a young person? Well, if you see these jobs, these careers, these career paths as potentially valuable in the future, then I think that's worth exploring them. Because if you become a specialist in that, then great. I think you're future proofing your entire life by doing that.
I would say another consideration that I've made, I kind of made my appeal to some people to consider, and it's not rational. You can't rationalize this at all. But when I got married, the man stood to my right, my best man, I met at university. And there are those aspects. It was my stepmother who told me before I went and said, one of the things that you will not be told by any university, by any careers counsellor or by UCAS is some of the people you meet there will shape your life because you've joined at this cross section of your lives where you're all kind of in the same sort of place. And university is a fantastic melting pot to find those people. I would like to think that still exists today. And the people that you're going to meet are at that similar sort of stage in life. And you can meet people who have had similar experiences, but in the other end of the country or from the other side of the world at university in a way that it does happen in the careers market. But because you've got that built-in hierarchy, that can sometimes be difficult to form that connection with it the same way. But at university, you're all kind of lumped in together. And it's a consideration. Is it worth the debt? I don't know.
Yeah, it's tough because I mean, when I did it, it was great. That was 100% part of it, and particularly in like my first year of uni, I mean, I would drag myself to a seminar or a lecture. I didn't really do lots of work, but I was paying £3,000, which seemed like a lot of money back then. But in retrospect, it's not compared with what they're paying now. I mean, I have had the impression that the graduates these days are sometimes a bit more serious about it because there's so much more money at stake for them. So perhaps I mean, I have no idea, but I would guess that perhaps there may be a little bit less of that. I mean, I went to university in Manchester where it gets talked about these kind of like the time when we were there, and it used to be like, some of the nights out and stuff were like they'd go in, the magazines as like the best place to pull in Britain and all this kind of just horrendous culture. Sorry to even bring it up, but I don't think uni's like that these days. It's just not anymore. I think it's so important though. That social aspect is really important, and you can't talk it down. But there are other ways to encounter that, right? You just might need a bit more work at finding them.
Well, let's now say you go to university, you get your job, and you're in a position to buy a property. And let's say you've gone down that white collar route, and you invariably, as many of us do, find ourselves in London. This is kind of following my trajectory, really, which is I bought a flat in London. It was available on the Help to Buy scheme, and I was able to buy a flat. Now, over COVID, flats took a big hit because people didn't need to be in London as much. Remote working became a lot more accepted, and the stats out from this week showed that flat prices in the entire UK in the year to December were fell by 0.5% to an average about £193,000, which is in contrast to a 2.4% increase of house price or all property types, about 270,000. So we're seeing these flat prices fall in value, but it's fallen most sharply in London. It's 3.6 decline across the entire capital. And most interestingly, I think Kensington and Chelsea has seen the highest fall, which is 12.4% average flat value decrease in the year to December. I have my own views on this, but there's been a lot that's been happening in the economy, and obviously we've had interest rates rise as well, which obviously doesn't help with borrowing. But then you've got all these other aspects around flats. What's your take on why this has happened? Why is London getting hit quite so hard?
Yeah, so there's a couple of potential things. It's very difficult to say with any kind of definitive proof this is why the flats in London are taking a particular hit. But there's a couple of things to it. I think the first thing is a lot of the stuff around leasehold reform is sending chills through the market. So you've got landlords on one side who are thinking, well, don't want to touch something with the leasehold, or there's just a lot going on there that's very unclear. I think that's undercutting the market, particularly in London, to extent for flats. And I think also it's kind of people who are buying are still very averse to, because it's much higher on people's kind of list of awareness at this point, where it's kind of I definitely don't want to have a leasehold because I just know the service charges are going to be high and I'm going to get, rinsed for it. I mean, there's reforms coming through, but I think it's quite murky. It's quite difficult. I think what's potentially more interesting about the London market in particular, although I think this is more to do with the luxury end of things, but I think possibly it percolates down the chain, so to speak. Is London, and we saw this during the financial crisis, London has a habit of being a bit of a canary in the coal mine in terms of housing prices. Now I don't know about where you are, Kez, but where we are, I'm in North Devon, and our house price in the past year or so has done really badly. We're well below what we paid for this property in 2022, which is really depressing. Um, but I mean, it's kind of there's no doing about it. I just have to live in it, and I keep paying the mortgage off, and eventually the house price has to start coming down. We will start building equity in again. So it kind of is what it is. You have to just sit on it. The point I'm making is that I've had a bit of a suspicion that there is a bit of a wider property market slowdown happening that I don't think is getting enough attention or enough. It's not being shown in the data well enough. And I especially think one of the big differences now between now and what we had in, say, financial crisis, when obviously house prices were going down, was there's a lot more masking of it, I think, in particularly with changes of the way the market looks. When you go and buy a house, it's like everybody goes on Rightmove now, right? Rightmove or Zoopla. That's the first place everybody goes to look at houses. So you stick something on, if it doesn't sell, people, I think at the moment, people are willing to just bide their time. There's a lot of biding time going on. Nobody's being a forced seller, because although unemployment has gotten a bit worse, it's not at terrible levels where lots of people are having to force sell their homes because they have to move somewhere else, blah, 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 et cetera, et cetera. So there's a lot of people who maybe want to move, who are patient enough and have a stable enough financial situation that they don't have to. So the problem you have then is that the property market looks like it's okay, but really there's not huge amounts going on in the property market. The data's quite thin. So I think there's kind of a lot of play there, if you get what I mean. On the flats in London, I mean, I think the good thing about this is actually we could be in a situation where if the bottom falls out of the market for flats in London, there's going to be opportunities for first-time buyers. People are going to start being able to get on the ladder. That's not a bad thing. I feel sorry for the people who are having to sell potentially at a loss. A lot of people have been sit on these properties for 15, 20 years, and their loss on paper is going to be very, very small relative to what they've earned in equity and paid off on their mortgage. So, and I don't. Cheaper housing prices are not bad for the economy, because it means that more people can move to the areas where they want to be and where they can be most efficient and earn the best money and have the best careers. It comes down to a lot of our central problems.
I think seeing that the boroughs that are most affected by this declining is Kensington and Chelsea, Westminster, Camden and Hammersmith. These aren't the poor boroughs. I had a flat in Newham, which is always one of the fastest rising for house prices, but that's because house prices were so low because it was a poor, deprived area. The one thing I would say to anybody, and I would not buy leasehold again. It was the ground rent actually was actually pretty steady. It was £400 a year. Couldn't be negotiated for, I think it was 20, 25 years. So that was steady. But the service charges were out of control. So when we first moved in, it went from £130 a month, and when we left, they wanted to charge us just before we sold just shy of £600 a month. And you're going, that is insane. The other aspects as well that we face, and you tend to find this in London, particularly with young professionals, they might start a family and then move out of London, as they climb through their career, is there's a real shortage of quality childcare. So what you then end up with is this postcode lottery, not around schools, but around kind of preschool and childcare there. And at one point, our childcare bill for 4 days a week was 2.5 times our mortgage. And it's all these other issues and when you talk about the social issues that come with this isn't just about people buying a property and it just being a one transaction. It is, are we happy to lock into this area for 10 years. And there are other aspects around that I would encourage people to really seriously look. And it's really difficult when you're 22 to 28, when you're in that cusp and job's going well and you get promotions and pay rises. But when it starts to plateau and you get around 30 and, you know, you're into the kind of trudge of the 9 to 5, that's when you go, oh, damn, I'm locked into this long term. And I've seen people who are now in a position where they were locked into a flat where the price has fallen, where they don't want to take the negative equity, and they have a parent die who then inherit a property, and then you go, oh, now I'm stuck with an inheritance tax bill. So there's all these other aspects that come with it. And do you think this is now, and with the renters' right bill as well, do you think the market is obviously called for landlords in London? Do you think we are going to start seeing flats becoming a hell of a lot more affordable, where people in similar to the 80s and 90s, where people were able to stretch a little bit, but go, you know, places like Westminster, Camden, where people are always going to want to come for work, that actually people might see an opportunity and go, damn it, let's take the risk?
Yeah, I think, look, there's a lot going on with what moves prices in the property market, and obviously higher interest rates have kind of been the number one thing that have meant that, I mean, in kind of real terms, when you look at it versus inflation and kind of wage growth over the past 3 years, houses have become more affordable. That's the kind of crazy thing, is home ownership has become more affordable. What has not up until this point become more affordable is mortgages, because rates have gone up. We are now, I think, at an interesting point where rates are coming down, and I think they're going to come down. Actually, I'm quite positive that they're going to come down more than the kind of general expectation. I think possibly because the labour market's going to start looking quite bad, but that's happening. We're also seeing like loosening of the affordability measures. So there's some mortgage providers are now offering out like 98% LTVs, although some of the kind of rules behind that were a little bit silly, to say the least. But look, the affordability criteria is getting easier, and that's going to help people get on the ladder. The problem is that we don't build enough properties, so that's just going to stoke house prices again, because you're just boosting demand. You're not dealing with the supply issue as well. The crazy thing in the property market is the number one easiest way to solve everybody's problems is to just build lots more houses. It's a very simple solution, but nobody wants to do it. If you look at housing starts in London, they've fallen off a cliff in terms of property building. It's absolutely, for a city that's supposed to be a major global centre and an engine of the British economy, etc. It's absolute. The figures are absolutely just dire. Look, I mean, if I were to ask, and I sometimes have this joking conversation with my wife about this, is because we met in London. We lived in a little flat in Balham. We got mates rates on that flat during the pandemic. It was incredible. We moved out to Devon because the house prices were a lot cheaper. We were never going to be able to afford to buy in London. It just wasn't on the cards for us. But we could buy a 3-bed house in Devon for not a crazy amount of money, sort of thing. And look, where we are, the cost of childcare is great. We don't spend huge amounts of money on our childcare. It's very, but we're lucky in this, because I'm able to kind of parlay a bit of a London living out here, and I have a boss who's kind of, happy for me to do that. It's not everybody's got to that easy, but the more general trend that I see through all of our friends is everybody's just getting out of central London. Everybody's getting outside not everybody, but a lot of people getting outside the M25 actually, and people just commute in, especially now because you can commute in 2-3 days a week. You don't have to go in 5 for many people. So I think there's just a lot of nuance, right? You just got to find what's best for you. I kind of would love to live in London, but I don't want to I would never want to go back to living in a flat, setting aside the childcare and all that sort of stuff. We like our space, and that's kind of fine for us,
When I was a journalist in my early 20s, my editor lived in Tooting, I think, and we'd always make the joke for her. She'd say, "Oh, I had to run downstairs to get the door or something." I said, "Oh, posh, you got stairs," because everyone else is in flats. But I think kind of drawing quite nicely is if you're in that position where you are able to get a mortgage. We've now seen this post-pandemic where particularly there was a lot of free cash in COVID. You know, people working from home, lots of financial commitments people didn't have to make during the pandemic. Lots of people were faced with this dilemma, particularly when rates were so low. Should they overpay their mortgage or should they invest? And it's kind of been brought to the fore recently with Sprive going on Dragon's Den, which is this app that allows you to essentially pay for transactions, and you get a kickback from the retailer to pay or overpay your mortgage from it. What's your view on this? Because I've got very strong views, but it is entirely individualized for me. But I'd be interested to hear on your view on this, and if it's something you have done yourself.
Yeah, so I mean, this is the point where I'm going to give a shameless plug to my own podcast here. So we actually had, so the guy who set up Sprive, Jinesh Vora, he actually came on the Mouthy Money podcast last week to tell us about it. And I think it's a fantastic idea because, and then we talked about this with him, but he's doing cashback. It's cashback, you know, everyone knows cashback apps or cashback sites and that kind of thing. I'd imagine most people have had a go at doing cashback or trying out. And my own view of cashback is, it's okay. You know, you're never kind of earning enough money for it to be that exciting, really. And you can't be bothered with it. I couldn't be bothered. You can't be bothered with it, basically. I find this version of it, because it's cashback, but then the app lets you then pay your mortgage off. He's basically just created a way to do that easily. I find that more compelling because there's an element of gamification in it, kind of how much can I get on this, and then how much is that adding up, and then the app will show you the little sums as this is how much, you know, this is how much the pure cashback is, but once you factor in paying down your mortgage, you know, it like boosts that percentage rate of what you're getting, kind of thing. And it's great because there's no cost to you, because the way cashback works is you get, you know, a fiver back or whatever from your shop, and who's actually paying that is actually the retailer that you're shopping with, because all they're doing, it's a form of marketing where they're basically buying your custom at a slightly discounted rate, basically. So it's great. It's kind of, you know, it's win-win in that sense. The app, you know, there's a little bit of like a clunky hurdle to overcome where you get to the till, you put everything through on the shopping, and then you have to look at how much the shopping costs, and you have to quickly jump in your app. I don't know about you guys, but the amount of times that my phone doesn't have any signal when I get to the till, you know, when I'm in the shop, it's probably more than comfortable. But I get it, right? I get it. I think it's a good idea. Now, the broader point about overpaying your mortgage, I used to be quite skeptical about overpaying the mortgage, particularly because the biggest argument against that is, yes, you can overpay your mortgage, but how much is the percentage interest, and how much interest could you earn if you took that money and instead invested it somewhere? Now, obviously, you know, past performance, etc., but broadly speaking, yes, if you invest that over the long term, you will get a better rate of return than if you just paid off your mortgage. I think that argument now, especially given so many more people are on much higher rates than they were pre-pandemic or even just pre-cost of living crisis, has changed that calculation somewhat. But I think there's a bigger picture thing as well, where, and we've kind of alluded to this, where people get on the property ladder later in life, you know, typical buyers over 35 and this kind of thing. And if they're taking on a 25, 30-year mortgage often to make it more affordable, you're going to be 65, 70 potentially, but by the time you pay off a mortgage, especially if you get a starter home and then maybe you want to move up the ladder into something slightly bigger and you have to extend the length of it a bit longer after 5 years. That's something we're thinking about doing at the moment. This all feeds into it, and the thing that I think is so is just, let's call it not good, is being retired and still having to pay a mortgage. That scares me, having to do that personally. I'd never want to be in that position where I'm still having to pay off a mortgage in retirement. And I know I have friends who are in that situation, and it's a cloud over them. So in that sense, yes, I think, I mean, you know, you can argue about the numbers and this kind of thing, but I think there's a powerful emotional and security outcome attached to getting that mortgage paid off, which I think you can't talk down really. I feel like I was going to go into this being a little bit more equivocal, but I've talked myself into being really pro paying off your mortgage early.
I 100% agree with you, which is it sometimes isn't academic. It's not the theory, it's the emotion. People are very emotional about their finances. We know this is so much on behavioral research and behavioral science on how much people react to things. And one of the biggest financial commitments, if not the biggest, that people make in their lifetime is property and their mortgage. If you can get that paid off, particularly if you get paid off before 60, when people are looking to wind down, you know, people do have a bit more discretionary income. That's when you see people go, I've got this chain that was shackling me down to a degree, i.e., I have to stay in that job, I have to earn this salary. That disappears. It tends to be people's biggest monthly expenditure as well. So if you lose £1,500, £2,000 a month that you have to pay, all of a sudden, what does that mean? Well, with the amount I've got in my pension, I now can retire a bit sooner, or I can just turbocharge my pension for the last couple of years, or I can spend the money on what I want to. I can go and buy that dream car. I can do that, and it just gives you that bit of freedom. Now, they do this a lot more in America because we don't tend to have these kind of really short-term mortgages as much, the kind of 10, 15-year mortgages, or they're a lot less common. We are kind of a nation of 25-year mortgage holders. But as you say, as people are having to take out longer mortgages, and there's a general rule of thumb, the longer your mortgage, the more you should try and overpay in order to bring that interest down. I'm sure you've had this when you took your mortgage out initially, which is you look at how much you'll be repaying versus the cost of the loan. And it's very easy, if £300,000, £400,000, you're easily paying back over £1 million. And I think what people need to understand is that as your term comes down, it's more of the actual loan you're paying off because the interest is added on monthly. And it's a bit difficult to imagine on a podcast, but essentially the front end of that loan, the first kind of 10, even 15 years, can be predominantly interest. So if you can overpay that overpayment comes off the principal. The less principal you've got, the less interest is being added onto it, which is how you get that snowball method. I think you're right, though, as people are taking out these longer and longer loans, it's probably more of an imperative to, and we're not a nation of investors. We are savers. It tends to be more of our culture. And I wonder if that's how we're going to go in a way that America, you know, the because you have to kind of do a lot of your own Roth IRA and retirement planning yourself, the financial advice market is a lot more open for that kind of thing. I wonder if we're going to start seeing overpaying as a more of a cultural thing that we do in the UK versus what people in America do, which is invest. But I think there's a balance to be met. And do you think that for most people there is a balance which is apps like Sprive are fantastic, add that little bit of friction into your shop and do the overpayment where you can, but you've got to stay invested?
Yeah, I think I mean, my first cynical reply to that would be that if large numbers of people start overpaying their mortgages, I think the mortgage providers might start getting a little bit upset about that, might start changing some of the terms, student loan style. I think because you have to make sure you can do it in the first place. You know, when you get your mortgage, it's important to check whether you can make overpayments, because not everybody offers it. Some offer a very limited level. Something I checked, and then shamefully we've now had it for nearly 5 years, and I haven't overpaid a penny, which I need to start thinking about. I think you're right, though. You need to have, and look, it can be really difficult. Like, I think about our institution. We've got a mortgage, we've both got pensions. I'm now trying to contribute to junior ISAs for my sons in case they want to go to, you know, bring the topic all the way back around. You know, you feel like your monthly income is being picked apart by all these different obligations where there's no immediate benefit. It's something that's promised to you in the future is going to be good if you do it. It's very hard to adjust your behavior for that, but the payoffs of doing so are phenomenal. So, I mean, I think the first thing you have to do is, okay, look at, you know, overpaying your mortgage, and with a pinch of salt, I would say use tools like ChatGPT, because if you're using that stuff already, it can be quite good for modeling. Well, if I overpay X and my kind of rate is this and that, it's quite good. I mean, I do it. You have to take it with a pinch of salt and be careful and not start signing off things necessarily on their basis, but it can give you a good idea. But beyond that, you have your contributing to your pension is so important. You should never ever give that up, especially because you get those workplace contributions that are it's free money. It's like taking a pay cut if you turn them down. And then I mean, look, we get a lot of like discussion about pension or ISA and this kind of thing. And I used to be quite pro ISA because I don't like how complicated and annoying pensions are. The pension system is a nightmare. But actually, the additional upfront cash that you get with the tax relief and stuff, it does have quite a significant impact. So I would say contribute to an ISA if you can, and if you want something that's maybe a little bit of a shorter term goal than just fully retiring. Otherwise, your pension, that's your vehicle to invest through. People don't know that they're investors when they've got their pension. Your pension is an investment. It is invested unless you've got a final salary scheme, which only really people in the public sector these days have. It will be invested and you should be paying attention to that. So it's not even necessarily about contributing more. It's just making sure, is your pension invested in the right thing? If you're 25 years old and you're in a default fund, how much of that default fund is in bonds? Because you shouldn't own any bonds. You should be in the stock market, and that's it. So you don't have to just contribute more. Just make sure that what you're doing already is getting enough out of its future potential. I think that's so important. And so I'm going to get quite heated about the pension thing because it's we don't pay enough attention to it. We just don't. Everybody is investing already. You just maybe don't realize it.
I realized it when I was working at Morningstar, and this is when it all came full circle for me, which you look at all these fund flows and X billion is going into this fund and X billion out of that. And me being a kind of cynical working class people thinking investors are over there is thinking, well, whose money is this? And you look at the largest investor for a few of these funds and you go, it might be a certain county's pension fund or teacher's pension fund, something like that. And you go, it's our money. And you very realize that a lot of this is built on the collation of lots of people's pensions that then creates funds and a lot of the market around. There are obviously high net worths, family offices, etc., hedge funds who do a lot of this stuff as well. But a lot of the stuff on the open market you can invest in on any of these apps, a lot of these funds are being driven by the amount of cash that we've got sat in pension funds that very few of us take control over. And the one thing I did, which I would encourage people to do with 2 steps, which is use some of these pension combined tools and bring it all together and get them to work out where it all is. Because that can be really helpful to see where it is. And then second of all, have a look and see what the fees you're paying on those are. Because I use profile pensions, which is really great for. I had like an old Halfords pension from when I was 18, still going somewhere on Nest. I had one for my first job, and by the time I'd brought everything together, it was about 15 grand in cash. I just didn't realize was there.
Yeah.
What I then realized was the workplace pension I was on, it was at Morningstar at times, so with Aviva, it was about 1.2% lower fees a year. And then you go, right, so this money that I've got, which is still growing pretty well, is being eroded by the fees. If I move it all over into one and then actually speak to the pension provider and go, where am I invested? What can I be invested in instead? You can very quickly make some serious gains on that if you are happy with your risk tolerance and your time frame. Because I think people have had this when I post things on TikTok. People will say, I don't want to be in the stock market. I could lose all my money. And it's trying to just cut through that noise and go, don't just buy a stock, just broad index fund investing is often really good. But there's a couple of really simple steps I think lots of people can make to help boost their pension and literally without contributing an extra penny.
Yeah, 100%. Yeah. I mean, I did that. I consolidated all my kind of old little pots and I stuck it on AJ Bell and I mean, look, I think the vast majority of people who not spending all of their time like I do and like you do as well, Kez, I'm sure, looking at what's going on in markets and this kind of thing. Global index tracker, 0.05% charge, whatever, forget about it, just leave it, ignore it, look at it in 30 years kind of thing. I actually combined it a few years ago and it was sat languishing, not doing very well for quite a long time because I had it stuck in something that was underperforming, which was quite silly. But I was one of those ones who decided to start putting some of it into gold quite early last year, and let's just say I'm very overweight gold at the moment. Going into too much detail.
I had Simon Popple, who's the CEO of Brookville Capital, who helps people buy
Yeah.
physical gold, on the podcast a few weeks back, and obviously he's very pro gold, but he has this formula of how to invest in gold at different levels, and you've got it at kind of ETF level right up to the explorers, which are the most risky. And I think so much of this just comes down to risk tolerance and time frame. It's very straightforward. If you're young, you can afford to be risky. You can afford for things to potentially make less of a return in the short term, with the idea of making long term. And as you say, as you get not having money in bonds, but as you get older, you need that guaranteed income. That's where you can start to do this. And we very quickly touched on fees, because you're a lot more kind of in the market and in the weeds of some of these products than I am. If you were to say to people like, I've got this, but how do I know if the fee's any good? Are there kind of upper limits you would say if it's above X% avoid?
Yeah, it's a tricky one, fees, and look, platforms, there are some great ones out there, but there are also quite a lot who make their fee schedules complicated for a reason, because they make it difficult for you to understand how much it's actually costing you to do this stuff. Generally speaking, as a rule of thumb, if you have got a smaller pot to play with, then look for a kind of percentage fee, and the lower the percent, the better. Then you have to look at stuff like, the fees for buying funds and trading and that sort of stuff, because when you want to actually buy the investments, and if you're not going to be doing any, or you're going to be regular contributing, so there's quite a few of the platforms will do fee free if you're doing like a regular, direct, like a monthly direct debit of 100 quid, and you're buying X fund every month and continuously. Quite a few. I'm not down on the details of it, but some will offer just fee free for that. So you have to kind of watch out for all of that stuff. But the percentage rule of thumb is, I think, the basic one. Once you're over a certain level, obviously that starts becoming quite expensive. If you've got 50 grand in a, then it starts to look expensive on the percentage basis. And generally speaking, I think there is one kind of standout platform when you get over about 50 grand, and that's Interactive Investor, because all of their fees are flat fee. So basically, if you're under like 40 grand or so, you're probably not getting a great deal out of the Interactive Investor platform. Once you're over and you're that higher value, it's almost certainly better value on Interactive Investor. It's a funny way the market works. They're pretty much there probably are others that do flat fee, but that's the only really mainstream one off the top of my head that I can think of that does that. So yeah, it's just be aware of those percentage levels. Look, you have to pay for it. It's just, it kind of, nobody gets it for free. But it's just making sure that, like you say, it doesn't get eaten up. And I think, having stuff in one place is usually beneficial, especially because if you are able to combine stuff and it goes over 50 grand, then pick a fixed fee platform, because then you're not going to be paying huge sums to keep things going.